and I totally understand how you're presenting it with different methodologies. My question is it one money manager that is employing all of these different methodologies so that your client has one money manager to deal with? Or are you doing kind of like what we do with AssetMark, where we have 2 or 3 or 4 different money managers who have different methodologies and then combine them into one account?
Want the truthful answer, or do you want something that makes you feel good?
No, just truthful. I dig this.
Okay.
Philosophy.
You're not going to like the truthful answer. The answer is yes, no, maybe, sometimes, always, never. It's like whatever you want. You can do it either way. Yes, we do have a couple managers that can do it all. Okay. But we also have, that's why we teach this thing of what we call the adaptive optimizer. Well, how do you blend these different things together without being stuck with a formula? Because the market doesn't play to a formula anymore like it used to. So
exactly.
There are ways to do it, but the caveat to it, which nobody likes, no one's going to admit to this, it's a lot of work. When you go into even learning what it is to do trend aggregation and you see this, a lot of reps eventually ask, well, if it's so good, why isn't all these other, managers, why isn't a lot of other managers doing it? If this is really that good, there's a lot of brilliance in this industry. Well, the reason is because it takes a long time to learn this, which is a lot of work. And once you learn it, it's even more work to do it. All right. So for someone who's looking to create a methodology that just might need a little tweaking here and there, and then rock along and go out and give talks and live on the golf course, Trend Ag's not for them. Too much work.
Ron, I'm back.
Okay, so we were going to talk about actual diversification.
Yeah.
Why you have multiple wives.
Yeah, I wish. Actually, no, I probably don't wish. That'd be scary.
There's a thought that goes both ways.
Yeah.
All right, go ahead.
On the one hand, I'm thinking, yeah, that's pretty cool. And then I'm, no, that's not a good thing.
Yeah.
So, first off, like I was talking about in the Good Harbor example, you want to combine methodologies that can go up at the same time, but that have different Achilles heels. So, in the example I just gave, momentum methodology, is not going to do well in a choppy market, but a counter trend methodology will, and a counter trend methodology still can do well in a straight up or down market. So that's how you have actual diversification. And there's a bunch of different ways to do that. Number one, you're diversifying by methodology. So you're combining different methodologies that have different Achilles heels, different markets that they don't do well in. The other way you can do it is by time frame. Back in the day, when everyone was starting out doing tactical, everything would move on a monthly basis. And, now you can combine that. I would argue monthly is way too slow in this market. Now we've got things that move on the half an hour. We've got things that move every 60 minutes, 90 minutes, 120, all the way through. Our longest time frame for rebalancing something is a day. We do have some daily models, but the bulk of our models rebalance at some point during the day, some going down to rebalancing every 30 minutes. And
now, Trend Ag has not evolved to be like the leading day trader thing. It evolved to these small time frames out of necessity of the changing in the market. But what I was talking about when you weren't on here, Matt, it is why don't more managers do it? Because it's a gigantic amount of work. Man, if you don't love it and you're not on it 24/7, you're not going to be able to do it. Or
right.
Take the time to even get the feel for it. It's gigantic in the scope of what it takes to do. And you'll learn more and more about it, but you see the difference between what I want to make sure is, because I want to move on to session 2 here in a minute, is the difference between asset allocation, MPT, partially tactical, fully tactical, non-diversified, and Trend Ag. Each one just an evolution to the next step. Does everybody see that? enough right now, because the rest you can read here. Because actual diversification, you're diversifying methodologies, not, Bill, what we were talking about, what you said is large cap methodology. No, you're using different methodologies, which I guess, Matt, you can label a few of them, and time frames. So let's label again a few methodologies for actual diversification, and we'll move on into day 2.
Okay.
Here.
Yeah, I mean, momentum is the simplest. You're basically buying what's strong and selling it when it gets weak. Counter trend, you're doing kind of the opposite, but you're doing it in an entirely different time frame. So a counter trend methodology, you're buying into weakness and selling into strength. You've got intermarket methodologies where you're looking for divergences between things that tend to move in tandem. For example, you could look at, Apple versus tech stocks, where maybe if you've got a period where Apple is going up, but tech stocks as a whole are going down, that could be a bearish divergence for Apple. On the other hand, if you've got a period where Apple is going down and tech stocks are going up, that could be a bullish divergence for Apple. You could do pattern recognition, where you look for certain patterns and then maybe buy into breakouts after you've seen that pattern. You could do cycle analysis, where you're measuring the cycle of a market and basically shifting between trend and counter trend methodologies based on what cycle, a stock or a market happens to be in. So those are some of the main ones.
All right. Any questions here before we move on?
No, that was actually
day 2.
very helpful, just from a nomenclature standpoint.
Yeah. So what does TrendAg do? All that and more. How many in some of your top, more complex models? How many models are you running in one strategy, Matt?
So
or product or whatever.
Yeah,
just approximate. I don't need exact.
Approximately like 130 or so.
Yeah. So it's a lot of work, right? And it's a fascinating thing to know that you can control some aspects and outcomes and different things like that, but it's a gigantic amount of work. So does that answer your question a little bit, Alejandro?
It's totally. Thank you.
Okay. Now, nothing.
Wait. I had a quick question for Matt.
1 second. I just wanted to make one comment to Alejandro. Nothing wrong with AssetMark. They're fine. Okay. But what you have to ask yourself, and we're not going to get into it here, is, well, if they're that good, why don't we centerpiece them in the network? All right.
Mm-hmm.
Again, no problem with them. All right. But again, what we centerpiece here is stuff that can't be touched. Otherwise, it's too tough to market. Because it's
I think
a flooded out economy.
A simple the difference between good, having it good, and having it great. I think AssetMark is a very good.
Good is fine.
Very happy
and
it's
good is good
there's
enough.
Other strategies great.
And what if we took you into great, but you're not at peace? It's not going to work. So you guys have to make your ultimate decision. Okay, someone has a question for you, Matt, and then we will move on to second.
Yeah, question. Matt, Hyland, when in your models, do you change the percent allocations of the different strategies?
Not to be answered at this point. You're like you're kind of ahead of the curve. We will get into that depth, Hyland, but not yet. You were one of the ones I named that we hate because you're smart and you learn it too fast. So just basically just drink a bottle of wine and slow down so you could be at our speed. Okay?
Sorry.
But we will get into that stuff, I promise. Okay.
Thanks.
Any other questions that are not at a PhD level here?
Yes. Okay. Underwater correlation on the terminology. Don't you mean underwater non-correlation? Because when you're describing, it correlates when it goes up. It does not correlate. You don't want it to correlate when it goes down. Seems to me the term underwater correlation, when I first heard that, it was like, oh, you want it to correlate when it's underwater? No, it sounds like you're wanting it not to correlate with underwater, which sounds to me like underwater non-correlation.
Right. You want underwater non-correlation. The terminology, you're looking at the level of correlation on an underwater basis, and then you're looking for things that are uncorrelated. So it's just like in modern portfolio theory, you're looking at the correlation between, small stocks and large stocks, but you're looking for it to be non-correlated with each other.
Okay.
A semantic thing. Sounds like maybe he's not from Planet Money Manager, but maybe your great-great-great-great-grandfather was, and you have something in your genetic pool that would cause you to be so anal about terminology. All right. Anybody from Earth wants to... But you're right.
But the terminology means things. You picture these things in your head.
Hey, I know, Nancy. I try living with my wife. It's like having a red pen poised to jab your eyeballs out at any point, because heaven forbid I put a comma in the wrong place or I use a word the wrong way. Thank you. I just had some post-traumatic stress here, even though I do love my wife. So, anybody else have a question from Earth?
I can't promise this is from Earth, but I'll give it a stab.
Okay,
this is
let's
Bob
take a shot.
New Jersey. So,
yeah.
How do you determine the underwater correlation?
Is this Bob? I can't commit to my girlfriend of 8 years from New Jersey, Bob.
No. That's a different Bob.
Okay, all right. All right, go ahead.
Thanks for bringing that up, Ron.
Go ahead.
How do you determine uncorrelated underwater correlations? I mean, in MPP, we look historically, but it also depends how far back, what time frame you look at. And if the answer is, well, we look at it dynamically to determine correlations, isn't that too little, too few of a data point?
How about we answer that one? Okay, but how about we answer that into this next section on due diligence? I think
Perfect.
that would correlate quite well to answer that question in terms of how do we research stuff?
Yep.
Okay. And notice how I so liberally use the word we when I don't do shit. I could manage your money till you don't have any left. That's about it. But it's so fun to semi-take credit for something you do nothing for. Anyway, so let's go into section 2, which starts with due diligence, which goes right into, eventually we'll answer your question there, Bob, because that was an excellent question. So let's go to your next PDF. Looks like page 4, a kind of brief comparison between normal due diligence, which we call backward-looking due diligence, and forward-looking due diligence. But Matt, let's just talk about normal due diligence, what it is, why it's so popular, and what the heck is wrong with it.
Yeah, so normal due diligence, you're looking at past performance and trying to use it to predict future results. So you take a money manager, you take a stock, you take an asset class, mutual fund, whatever it is, you look at what the past performance is, and then you make the assumption that that past performance is going to persist into the future. That's how your clients do it. You know, some financial advisors might get a little more sophisticated. Well, you know, they're going to look at alpha and they're going to look at standard deviation and beta and Sharpe ratio and Sortino and Trainer. And, you know, if it's a money manager, we go and we do an office visit and we look at their operations and we make them fill out this 30-page questionnaire about all sorts of stuff. And then basically we look at the past performance and assume it's going to persist into the future. And why it doesn't work is the same reason that...
Boy, before we go into why it doesn't work, let's talk about, I mean, when you say it like that, it's just a big smack in all our faces about like, well, that sounds stupid. You know, in everything that we have in this industry says past performance is no indicator of future results. Okay. And Yet it's what everybody buys into. Why? Why is something that makes no sense? Why is it so popular? And I have some of my philosophies on that.
Well, yeah, and you're asking me to comment on something emotional, so I may get this wrong, but yeah, number one, it's easy. You know, hey, Mr. Client, you want to buy this fund? Oh, let's look it up on Morningstar. Oh, yeah, 5-star rating, 15% a year over the past 5 years. This is awesome. I put $1 million in this. I'll be a gazillionaire in 10 years. This is great. So, I mean, I think that's one reason. The other one is greed. You know, you see stuff going up and, you know, you're watching CNBC and they're talking about Bitcoin and, oh man, it's doubled. So obviously it's going to double again. You know, so I mean, those are my thoughts on it. It's simple and greed is powerful.
Right, and if it's simple and it's understandable, I can feel I can control it. It makes sense. I have two theories on why it is. One is that in days gone by, long-term trends are actually long-term. You know, you can count on a trend staying in place for quite a while. Now, if you go to the bathroom too long, you're going to miss a long-term trend. You know, that whole gamut changed. So we'll go into that when we go into understanding today's market action. But so that's one thing. It used to be where it would at least look like it was true for a while. Okay. That's one thing. The other thing is we all have a God hole. You'll hear that talked about in different religious aspects and things like that. But nobody wants the real answer. Everybody wants the God answer. I've got this. I know what I'm doing. Here's a certainty of the future. Let's go. All right. And past normal backward-looking due diligence makes you feel like there's a certainty going forward. Past is the indicator of the future, which it basically isn't. Okay, but it makes us feel more certain of our own future if we have something to lean on. You know, case in point, I always bring up, for instance, like health insurance, which is all upside down, right? You know, we still don't have it all figured out, and you know, it's still all screwed up. You know, and of course, we look for our political leaders to bring the answer. But who here would vote for a leader? And some of you have heard me do this as an example. If a leader got up there and says, look, guys, yeah, I'd like to be your president, and this whole thing with healthcare, I'm fucking clueless. Okay? All I know is it is plenty screwed up. I have no idea even where to start. But what we're going to do is get a couple dozen brainiacs from both sides of the aisle, right? And we'll come together and create maybe a half a dozen or dozen different things to try. And we'll see from that, by process of elimination, maybe the top 3 things that work the best. And then we'll try variances of that. And then we'll narrow it down to 1 and try some variances of that. And sooner or later, all together, we will find the answer to this. Now, because nothing beats trial and error, which is the truth. You know, all the analysis in the world you want to do is just, it's all speculation, you know. So, and now that doesn't mean don't get all black and white and think you should never analyze anything, because that's stupid too. But because we are looking for someone to say, look, because of that, this will probably happen in the future, we all sit with that kind of, we need that kind of godlike direction in our lives. And that's why we buy into bullshit all the time. That's my theory, Matt, on Earth. Okay? So, why doesn't normal due diligence, because all of you do it here, you know, well, I'm going to take a look at what did it do last 3 months, last year, 3 years since inception, measured against some benchmark, you know, and because I know the number 5 is much bigger than the number 3, I have now done research. And like, who here really, when you get down to the basic foundational brass tacks of normal due diligence, what 14-year-old couldn't do it? So stop thinking you're bringing some great amount of research into the loop that's helping. Why doesn't it work, Matt?
Well, I mean, I don't know if I can comment any more beyond what you said, but I mean, past performance doesn't predict future results. Plain and simple, what is going up, and up isn't necessarily what's going to go up tomorrow. And,
all right, so we'll go to the next page and go to page 5. Let's talk about some extreme examples. All of these things people have lost their ass on. I see Bernie Madoff's right up top, and Matt, I know you had a personal experience with that game there. And we had a couple clients that were part of a CPA firm in Minneapolis. One lost $50 million, another lost $100 million. We didn't know till after the fact they were with them, but so Madoff might be extreme, but that was real. So let's talk about some of these. These are all backward-looking due diligence explosions for people.
I'm not looking at it, Ron, so if you want to read them off to me.
Well, how about your little, everybody knows what happened with Madoff. How about let's hear about your example with Madoff, because you ran into it before it was called out.
Oh, yeah. I mean, years before. So I had a client who had come across this hedge fund of funds, which wasn't far from me. They had amazing track record. They're making, 15% or so a year, every single year, no deviation at all. And, but they had a high minimum. So she called me up. She's like, hey, Matt, can you, go meet these guys? They're right down the street from you. See if you like them or not, and see if they'll lower their minimum. So I went, I met them, really nice guys. I mean, awesome guys. And, seemed pretty smart. The one thing I couldn't wrap my head around is they really didn't, they were generating amazing returns, but they really didn't seem to have any idea where their returns were coming from. And when we talk about forward-looking due diligence, that's key, is understanding where your returns were coming from. And they're just, and they weren't being secretive. They're just, hey, we're killing it, but yeah, we don't understand this market, and this doesn't make sense, and this doesn't make sense, but hey, we're making money. And I walked out of there. I called the client. I was like, look, yeah, they're doing well, but something's not right. And, I wouldn't invest with these guys. I don't see how it can continue. Something's just not right with it. And, she didn't invest. I forgot about it. A couple of years later, one of the guys from the firm called me. He's like, hey, Matt, I'm with this new firm now. I'd like you to take a look. Like, well, wait a second. What happened to you guys? You were killing it. Why'd you leave? He's like, oh, yeah, half of our fund was made off. Like, okay, that makes sense.
Long-term capital.
Yeah, so long-term capital was really good from, backward-looking and forward-looking. So long-term capital had like 3 or 4 years where they're making 40% a year with no volatility at all. And so if you look at it from a forward-looking due diligence standpoint, okay, well, where did their returns come from? Well, they were doing arbitrage. Great. What is the one thing we know about arbitrage? Once everybody kind of figures out this arbitrage stuff, the excess returns go away. So what happened? Every Wall Street trading desk was tripping over themselves trying to figure out what long-term capital management was doing. Once they figured it out, the trades got too crowded. They bumped up their risk, and kaboom. They also messed up on their models where, they didn't do forward-looking due diligence. They ran their models, and at one point their models blew up, but they looked at what they blew up on and said, you know what, that can't happen again. So we'll take that out of our back test. And they were probably right. It can't happen again, but something else similar to it happened, and they blew up.
Were they the ones, or who was the hedge fund that they won a Nobel Prize for their methodology, and that just everybody lost their ass?
Not one Nobel. They had multiple Nobel. They were the smartest guys like ever. And again, 4 years of 40% a year, and then kaboom.
Wasn't their model right? It's just that they didn't take into account humans don't respond like computers.
They had a lot of stuff go wrong. I mean, number one, like I said,